This video pulls back the curtain on the strategic plays made by the top 10 hedge funds by assets under management, revealing their stock buys and sells during the third quarter of 2023, and uncovering the rationale behind their moves. BlackRock Inc.'s significant acquisition of shares in Kenvue Inc. signaled a strong belief in the company's potential. Kenvue is a Johnson & Johnson consumer health spinoff, and its debut was the biggest U.S. IPO in more than a year. Similarly, betting on the potential of Kenvue Inc., State Street Corporation also invested in Blackstone Inc., which reflects confidence in alternative asset management's resilience and growth prospects, despite broader markets' unpredictability. And it could be part of a broader strategy to invest in financial services companies that stand to benefit from rising interest rates, which generally improve margins for asset management firms. Geode Capital Management strategic increases in tech titans such as Microsoft and Apple spoke of a conviction in the sector's enduring growth, despite the headwinds of regulatory scrutiny and competitive pressures. Citadel advisors, led by Ken Griffin, mirrored this tech-centric approach, while also diversifying into healthcare with Humana Inc., blending growth with defensive positioning. Citadel's substantial investment in Activision Blizzard Inc. likely comes out of acquisition of Activision Blizzard by Microsoft. By investing heavily in Activision Blizzard, Citadel likely banked on the acquisition's premium. After acquisition, Activision Blizzard Inc. dropped from FTSE All World Index and has deregistered its stock. Dodge Cox showcased a classic value investing approach, reducing exposure to volatile sectors and increasing stakes in companies such as CVS Health Corp. that offer stable returns. The investments in healthcare, banking, and fintech demonstrate a preference for industries that are expected to benefit from demographic trends, technological advancements, and economic conditions like rising interest rates. Dimensional fund advisors' moves suggest similar emphasis on sectors that offer a combination of stability and growth potential, favoring investments in large, well-established companies in financials and healthcare. If you're interested in investing in commodities, stocks, crypto, indices, or bonds, you should definitely try Dukas Copy. You can invest with just one click, starting from $1. Sounds good, right? Simply scan this QR code or check the link in the description below to get started. Fill out the form and then make a video call with a Dukas Copy operator. That's all you need to do to open your Dukas Copy bank account. Your Swiss bank account with Dukas Copy will be ready to use the same day. Berkshire Hathaway's investments in SiriusXM Holdings Inc., Atlanta Braves Holdings Inc., and Liberty Media Corporation showcase a strategic diversification into media, entertainment, and sports. These sectors are traditionally seen as resilient to economic downturns due to consistent consumer demand. By investing in these areas, Berkshire Hathaway appears to be capitalizing on the steady growth potential and possibly the undervalued assets in the media and entertainment industries. Media and entertainment companies, especially those with unique content and intellectual property, can provide long-term value and growth opportunities. Primecap's investment in Walt Disney aligns with the general trend in the industry, focusing on a well-established player in the entertainment sector. Disney's diverse portfolio in content creation, theme parks, and streaming services offers a robust business model with multiple revenue streams, making it an attractive investment for long-term growth and stability. Primecap's significant investment in Intel Corp reflects a confidence in the semiconductor and broader technological sector. Millennium Management's increased position in the S&P 500 ETF trust indicated strategic play for broader market exposure rather than individual stock picks. Other major buys indicate the same broad brush approach. Activision Blizzard as a bet on an acquisitions premium. iShares as a testament to a view that small cap stocks could outperform in the current market cycle, which is being emphasized by selling of iShares Russell 1000 ETF, which tracks a large cap U.S. stock index and indicates a strategy shift from large cap to small cap stocks. NVIDIA and CRH plc, one a leader in GPUs, the other a global building materials company, suggest a focus on companies with strong market positions in their respective industries. NVIDIA's role in AI and gaming and CRH's infrastructure focus could be seen as attractive for long-term growth. Similarly, Fisher Asset Management's pivot to well-established consumer staples such as Procter & Gamble Co. and PepsiCo aligns with a traditional approach to hedge against market volatility. These companies are known for their stable demand across economic cycles, providing consistent dividends and resilient business models. The increased stake in United Health Group Inc. follows a similar thread of investing in sectors with inelastic demand, healthcare being relatively recession-proof. The addition of JP Morgan Chase reflects a vote of confidence in the financial sector, possibly driven by rising interest rates, which can benefit large banking institutions. The third quarter showed a clear pattern of these hedge funds gravitating towards stable, established companies with a strong foothold in their respective industries, such as BlackRock and State Street's interest in Blackstone Inc. and Extra Space Storage. This trend suggests a general hedge fund preference for resilience and steady growth in a potentially volatile market. Technology remained a prominent focus, with significant buys in industry leaders like Microsoft and Apple by funds such as Geode Capital Management, indicative of a long-term confidence in the tech sector's growth trajectory. Yet sizable sells in tech, EFTs, and Amazon by Citadel hint at a nuanced approach to tech, balancing between selective stock picks and a cautious stance on broader tech exposure. Healthcare emerged as a defensive yet opportunistic play, with Citadel's investment in Humana and Dodge, and Cox's investment in CVS Health Corp, Dimensional Fund Advisors' investment in GE Healthcare, Technologies, and so on, suggesting a shift towards sectors expected to offer stable returns even in the uncertain economic climates. The investment in entertainment and media by Berkshire Hathaway and Primecap Management underscores a focus on sectors resilient to economic downturns, capitalizing on consumer demand and unique content. The overall narrative of these portfolio adjustments points to a strategy that combines a focus on growth with a hedge against ongoing market volatility. The hedge funds appear to be positioning themselves to capitalize on sectors with solid fundamentals while also securing a buffer through diversification and selective investment in less cyclical industries. This strategic positioning underscores a broad anticipation of continued market fluctuations and a desire to balance risk and reward. As the market landscape continues to evolve, the actions of these financial behemoths will be closely watched for insights into the future direction of the economy and the stock market. That's all the time we have today on the Investment Brainstorm. I'm your host, Matthew Stevenson, in partnership with Dukas Copy TV. Remember, money can take care of you, it cannot take care of itself.